I'm Tom Turk, Dean of the George L. Arduous School of Business and Economics, and I'm pleased to welcome you to our first ever virtual economic forecast. In particular, I'd like to welcome our numerous board members, alumni, business partners, students, and parents that are watching this conference today. And I'd also like to thank our sponsors. For the U.S. segment, Edwards Life Sciences. The California segment is sponsored by Kaiser Permanente. The Orange County segment is sponsored by CEO Leadership Alliance OC. And our platinum sponsors, Julia and George Arduous, CoreLogic, March Capital Partners, Mechanics Bank, and RSI Holding. Our gold sponsors, C&L Refrigeration and Schools First Federal Credit Union. Our silver sponsors, City of Hope OC, First American Financial, the Morissette Family, and Whittier Trust. Our bronze sponsors, Right Care Childhood Language Center of California, Wells Fargo, and Yesai Properties. And finally, our media sponsors, the Orange County Business Journal, the Los Angeles Business Journal, the San Diego Business Journal, and the Orange County Register. We couldn't do this event without you. With the help of our sponsors and guests, the economic forecasts have raised over $2 million for scholarships over the years, including $120,000 from today alone. If you didn't have a chance to visit the virtual booths before the conference began, I invite you to stop by and see how they might help you with your business or personal needs. Now, while the economy may have taken a pause, we at the Arduous School have not. We've added several new faculty, including 2 nationally renowned scholars in accounting. Our graduate enrollments increased over 25% this spring. We hosted the 43rd President of the United States last fall and the President of the U.S. Fed last week. Poets and Quants has featured us as one of the fastest rising business schools in the nation. And our rankings now among graduate programs with U.S. News & World Report is 74th in the nation and 3rd among private schools on the West Coast. Bloomberg Business Week now ranks our undergraduate programs 34th in the nation and number 1 in California, ahead of USC. And this fall, we launch our new Master of Science in Real Estate. Designed in consultation with our founding board, this program brings together talented students, nationally known faculty, and industry leaders to provide the skills, experiences, and connections our students are going to need to accelerate their careers in real estate. We launched this officially just in January, and our inaugural class is almost completely filled already. Special thanks to our founding board for making this transformational opportunity possible for our students. But what about the economy? How much did the lockdown set us back, and what will the recovery look like? To explain it all to you today, with their views on the economy and markets are 3 notable Chapman economists. President Emeritus Dr. Jim Doty, Dr. Ramon Sphere, Director of the Anderson Center for Economic Research, and Professor Fidel Lawandi, Director of the Hoag Center for Real Estate and Finance. After we hear from the economists, I hope you'll stick around for questions, and you can submit yours by using the Q&A dialog box on your screen, or just email events@chapman.edu. Now join me in welcoming Jim Doty.
Thank you, Tom, and thank you all for tuning in. When I say thank you all, I guess you're around the world now. One of the benefits of having a virtual update forecast. Our ability to do it was made possible by these many sponsors, and on behalf of the A. Gary Anderson Center for Economic Research, I wish to express our gratitude to them for making this possible. It's not the first time I've done something virtually, because this semester, halfway in, as a result of the stay-at-home orders, all of us at Chapman were required to teach our classes in a virtual format, online. And thanks to the great leadership of Daniele Strupa, our provost, Glenn Pfeiffer, our deans, academic administration, I think we carried it off and it went over as well as can be expected. As indicated by the student evaluations. Those of you who have been to our forecasts in the past know that I always have an Academy Award runner-up and winner for the best response on student evaluations. I was a little worried this year because of this virtual format for half of the class. Well, the best response, the Academy Award runner-up, Drum roll, please. I like Doty more online than in person. Imagine how I felt when I read that 2 weeks ago when I received these evaluations. I hope you like me more online than in person as well. There's something else that you may not know about us, and that is Chapman's forecast accuracy. And I say Chapman's, not Jim Doty's, and it's our Chapman econometric models forecast accuracy. In a ranking between the years 2004 to 2018, where we were measured against the 25 blue chip economic forecasters from around the country. These are forecast agencies, universities, financial institutions. In the top 10, Chapman tied with UCLA for number 1. And since this is my slide, I took the liberty of putting Chapman number 1, even though it was a dead heat. People have asked me, why do you think it is that Chapman and UCLA's forecast most accurate? And I think there are a couple of reasons. Number one, we're among the few that have large-scale econometric models, multi-equation models to help us in the forecasting. Secondly, we have students in various classes, research methods classes, statistics, econometrics, that help us generate the forecast and keep our model up to date. There's one other thing for Chapman, and that is we measure all of our variables in year-to-year percentage change form, and that's very important, as I'll get into in just a second. One other thing you may not know about me, and that is, in addition to being an economic forecaster, I'm also a soap star, soap opera. I'm the character, if you haven't watched the best soap on TV, Bold and Beautiful, I'm the character Chapman on Bold and Beautiful. I'm the CFO, and one name, kind of like Bono or Eminem or Prince, just one name. And I have to thank, the reason I got on the show, and I've been on it now 6 times, is because the associate producer, Casey Kasperzik, is a graduate of the Dodge College of Film and Media Arts, the best film school in the world. Thank you, Casey, for making my stardom possible. And one of the problems with being on a soap is once you air a soap, it's never seen again. That's it. It's in the can. But because of COVID-19 and the dearth of new product, they actually started showing reruns. I didn't even know that until I got this statement from SAG. I am a proud card-carrying member of SAG. I got this statement for my $7.45 residual, but after my SAG membership dues, I received a check for $6.81. So as horrible as this pandemic has been, I mean, just horrible tragedy, there's always a silver lining to everything with this check here. Well, that brings us to our U.S. forecast update. But before I get into that, I would like to express my appreciation to our U.S. forecast update segment sponsor, and that's a great organization, Edwards Life Sciences, one of the most respected, most dynamic, innovative companies, not just here in Orange County, California, in the world, under the great inspired leadership of Mike Masalam. And here's a little video to give you a little more info on Edwards Life Sciences.
Innovation starts with inspiration, and we're inspired. We're Edwards Life Sciences, driven by a passion to help patients live longer, healthier, and more productive lives.
Welcome back, and we are now ready to get into the forecast update. And I have to, at the very beginning, I think, define our terms. There's a lot of confusion out there, all kinds of numbers being bandied about. 50% drops, 10% drops, 5%. What is it? Well, it depends on how you define your terms. Here's probably the most often cited, and the one used by the National Bureau of Economic Research, used by them in just recently, announcing we are in a recession as of the first quarter of this year. And that is looking at quarter-to-quarter annualized growth rate, which for the second quarter, when COVID hit, with its full intensity, a drop of 35% in real GDP. That is an exaggerated number. It doesn't mean very much at all. We didn't really drop by 35%. We really dropped more like 9%. But when you take a quarter-to-quarter rate and annualize it, the assumption is, what if that rate of 9% persisted into a second, a third, and even a fourth quarter? It would amount to 35%. The COVID hit in the second quarter. It's not going to be replicated like that every quarter for the next 3 quarters. That's why in our Chapman model, and for presentation purposes, a more realistic number to look at is a 2% increase actually for the first quarter, but more realistically for the second quarter, the economy in terms of total spending dropped about 9%. Huge drop, as you can see here. This is a measure of the cumulative change in real GDP from the beginning of the recession to the current period. And what I'm doing here is trying to put some perspective to the COVID recession with respect to what's called the Great Recession, the recession that had the most negative impact since the Great Depression of the 30s. And as you can see, even though the Great Recession persisted into 6 quarters before it was done and the recovery started, the hit to COVID was much sharper, dug a much deeper hole. So it was far greater than anything that happened during the Great Recession. There's something else that's greater that happened anytime during the Great Recession, and that is the response this time around in fiscal policy and monetary policy. Unprecedented, as you can see in these figures. Here's again, cumulative change since the recovery, when the recovery for the Great Recession started, since the recession started, the Great Recession and COVID-19. Notice how quickly federal debt, which is a proxy for fiscal stimulus, spending on the federal side, U.S. federal side, and as you can see, in just a few months, spending hit $2.3 trillion. The Great Recession never hit $2.3 trillion, and it took 2.5 years, 31 months, to get to something close to $2 trillion. That's fiscal policy. On the monetary side, using a very similar analysis, since the recession began, Great Recession and COVID-19, within a few months, Federal Reserve Board assets, a proxy for the aggressiveness in terms of monetary policy. Federal Reserve Board assets basically measure how many bonds out there, U.S. bonds, corporate bonds, municipal bonds, mainly U.S. bonds, the Federal Reserve Board is acquiring, stimulating the economy in terms of adding monetary stimulus. As you can see, around $2.3 trillion. In the Great Recession, took 9 months before the Federal Reserve Board got around to doing anything. And then when it finally did, you had QE1, QE2, QE3, but after all those QEs, the cumulative amount didn't even approach what the Federal Reserve Board has done in just a few months in bringing it to $2.3 trillion. Now, hope you caught the fact that both the fiscal stimulus and the monetary stimulus are about the same amount. Indeed, they are. Here's the federal debt, proxy for fiscal stimulus, FRB assets, a proxy for monetary stimulus, about $2.3 trillion. That's very important. Because if the federal government, through the CARES Act, for example, were to increase spending, but if the Fed didn't help accommodate that, the government would be taking money away from other spending that might occur on the investment side, for example, or in construction that might otherwise occur in the economy. To make it possible for the fiscal policy to have its full stimulative effect, the Federal Reserve Board monetized that by increasing the money supply. It's often called the Federal Reserve Board printing money, and in a way, that's what it is. The important point here is that this monetization made the full stimulative effect of fiscal policy possible. First time, I believe in recent history anyway, that there's been this coordinated, not legally coordinated, but maybe fortunately or happenstance, coordinated policy where they worked together in consort, and it had its impact. And it's the basis for our optimism in our forecast. Here's total payroll jobs in the U.S., and enormous drop. From the first quarter to the second quarter, a drop of 24 million. We are forecasting the third quarter, which begins in a few weeks. That's the July, August, and September quarter. We're forecasting that we are going to make up almost 50% of those laid off, furloughed workers, and that will continue into the fourth quarter with 6 million more jobs, which means that we will be, by the end of the year, adding 18 million jobs, which is 75% of the $24 million loss. In dollar terms, we go back to real GDP, not job numbers, but spending numbers. You can see the dramatic impact. This is quarter-to-quarter percentage change. This is that 35%, my first slide that I presented. And we are forecasting that we're going to have a 20% quarter-to-quarter increase in real GDP in this next third quarter. And then it will slow down a bit, but remain positive all the way through mid next year. Measuring it on a year-to-year basis, the extremes aren't there, but the recovery is clearly seen. And again, this is a V shape, less V because we're looking at year-to-year percentage changes, but still relatively rapid recovery. And significant because I think that increase, that V-shaped recovery, wouldn't happen if it weren't for the fact that we're in a very, very positive interest rate environment. Just comparing interest rates to the Great Recession, you can see COVID-19, it started out at 2% and dropped back to about 0.7%, the 10-year bond currently, and we're expecting a little bit of an increase through the end of the year. Look at the Great Recession. It started at 5, dropped a little bit, zigs and zags, and ultimately came down, but only to 2%. We're starting below that figure. So on the interest rate side, it's more conducive to recovery forces coming in quickly. Short-term rates, 90-day Treasury bill rate, very similar. Started out about 5%. The Federal Reserve started ratcheting down interest rates to the point where ultimately it hit 0, but it took almost 2 years for that to happen. COVID, it happened in 6 months. In fact, they orchestrated it over really a 2-week period. So just as fiscal policy and monetary policy has been unprecedented in terms of the extent of it, but also the timing, the same thing can be said on the interest rate side as well. Looking at interest rates into the future, the 10-year bond, which is at 0.7% now, we think there might be a slight upward pressure, about 30 basis points, maybe hitting 1% by the end of the year. But 90-day Treasury bill will remain at 0. In fact, the Federal Reserve Board, Jerome Powell, recently announced it's going to stay at 0 all the way through at least 2021. Of course, that's not a promise, but it indicates that at least through the end of this year, we can rest assured it will be very, very low. By the way, notice this inverted yield curve. Kind of interesting. This was the inverted yield curve that occurred last year that many forecasters suggested would lead to a recession. And here, 6 months later, which is typically what happens after an inverted yield curve, a recession follows a point when long-term interest rates are below short-term interest rates. That happens very, very seldom, but when it does happen, a recession follows. And a recession follows, just luck of the draw. This recession is a COVID recession, had nothing to do with the inverted yield curve. These low interest rates, however, will be very important on the construction side and on the housing side in particular. We have a Nobel laureate on our Chapman faculty, Vernon Smith, and he, along with Steve Gerstad, wrote a path-breaking book on housing and recessions and point out that almost every recession since the Great Depression has been caused by a sharp downturn in housing construction. Not this time. Here's 2019 in the U.S., there were 1.3 million housing starts. We're forecasting a drop, mainly because of the sharp drop that occurred during the second quarter, to 1.25 million. But that's a decline of 50,000 fewer housing starts in 2020. To give you a frame of reference, a comparison, to put this into perspective, the Great Recession, which was largely a construction-led recession, the drop over a 4-year period was 1.5 million fewer units. That's 30 times the drop that we're experiencing in the COVID recession. Overall, for real GDP, we see a big drop in 2020, mainly because of that devastating second quarter. Overall, for the year, we see a 5.3% drop back. Probably in comparison to other forecasts, we're more optimistic. I'm seeing forecasts of -8, -10, -12. But because of our confidence in the positive impact in the short run of fiscal and monetary policy, low interest rate environment, and the V-shaped recovery, the drop back will be -5.3. That's still the most significant decline that we've had in the post-World War II period for any year, including the Great Recession. By next year, we'll be back to a kind of a base rate, growth rate of 2%. I can't conclude this U.S. forecast without bringing up the potential problem relating to all of this fiscal and monetary stimulus. What are potentially the long-term consequences? And this, I hearken back to my professor at the University of Chicago and the great monetarist, one of the leading economists of the 20th century, Milton Friedman. By the way, those of you who don't know, Milton Friedman and his wife, Rose, donated their library, their personal effects to Chapman, and they are now part of the Rose and Milton Friedman reading room at the Leatherby Libraries at Chapman. So when this pandemic ends and people start traveling again, I hope you'll come visit that place here on our hallowed place on our campus. Milton Friedman, great monetarist, was the one who said, inflation is always and everywhere a monetary phenomenon. And here's what he was talking about. He was talking about the relationship between M2 and the CPI. Those of you who are interested in the history of economics, he and Anna Schwartz published a path-breaking work on the history of money in the U.S. And he measured this relation. They measured this relationship between M2 and prices. A couple things here in this graph. A lot of things are going on, but here are the salient aspects. Look at this incredible increase in the money supply. This is not exaggerated because of quarter-to-quarter changes. These are year-to-year percentage changes. So this means, just recently, the Federal Reserve Board jacked up the money supply, M2, by 20%. We've had nothing like that in our history. Unprecedented increase. There are also relationships here that I want to look at, and to that, Friedman and Schwartz identified here in the 70s point to the relationship between this always and everywhere inflation being a monetary phenomenon. Let's look at those two episodes. These are two episodes when the money supply went over on a year-to-year basis 10% growth. Notice that the money supply back in the early 70s increased from around 3%, double digit, approaching 14%. Initially, prices were declining. Lower prices. But eventually prices started increasing again. And the lag between the time that money started increasing and prices started increasing was 9 quarters. Similarly, in the mid-70s, again, another increase to almost 14%. And in this case, the lag was 7 quarters before prices started increasing. I even went back to World War II, post-World War II really, about the time I was born. And in this case, it was an increase to 20%, kind of like what we have now. And it took 6 quarters before prices started increasing to almost 20% on a year-to-year basis. Now, we don't have to just look at individual episodes like the 70s and the post-World War II period. We could look at the entire period from 1979. I apologize for this is for the edification of my econometric students out there who are listening in. Hope you're all doing well out there. This is regression printout. This is what forecasters live and breathe by. And for my econometric students, notice this beautiful Durbin-Watson of 2. That was made possible by using these autoregressive error terms. But the important point for the purposes of this update forecast is this result here. Turns out that the best fit for measuring the relationship between money and prices is 9 quarters. If you believe that it will take 9 quarters before this M2 increase, that 20% affects prices, here's what will possibly happen. The money supply, there's this huge increase recently with COVID, but most people don't realize that the money supply, M2, had been increasing now for a year. In the second quarter of 19, it was 4%. It jacked it up, doubled it to 8% annualized growth. Then you had this big shock in COVID to bring it up to 20. If you believe that regression equation and the results of the lag, of a 9-quarter lag before it has any impact, that suggests that we might see our first signs of inflation somewhere mid-year by next year. Now, if you're a new monetarist, not an old monetarist like Milton Friedman, but a new monetarist, that philosophy suggests, this simplifies it, but you don't have to worry about deficits on the money supply or in terms of fiscal policy, U.S. government spending deficits. Don't worry about them. But if you have any belief in monetarism or are worried about it, this will have important implications. It will have an impact on interest rates, certainly. It will also have an impact on the stock market. Thankfully, I don't have to talk about the stock market. My friend and colleague, Fidel Lawandi, however, will. Let me tell you a little bit about Fidel. He is the chair of the Hoag Center for Real Estate here at Chapman University. And in addition to that, I don't know how he finds spare time to do this. He also heads up our David James Financial Center and all of those Bloomberg terminals that our students are working on. So, ladies and gentlemen, here's Fidel Lawandi to talk about markets and pandemics.
Thank you, Jim. Welcome, everybody, and thank you for joining us this afternoon. This is going to be very interesting because if you attended any event where I speak, I have the tendency to pace. So for me to have to do this while standing in one spot is going to be interesting, to say the least, but let's see if we could get through it. So in talking about markets and pandemics, in order for us to kind of get a grasp of what's happening in the markets today, specifically the the equity markets, it kind of helps to look at what has happened in the past. How did the market react in the past to similar pandemics? So although COVID-19 has been much significantly amplified the impact much significantly compared to other pandemics. So for an example, if we look at China, we see that during the SARS epidemic in 2003, as a market, we kind of paid attention to it for a couple of months. The Chinese market, kind of from its most recent peak, drops to about 12.3%. And from once it reaches that bottom, within 60 days, we see that the Chinese markets kind of jump up to 24.1%. That's only within a couple of months of reaching the bottom. If we look at the global market in its entirety, we see that it actually went up during that period of time that the Chinese markets were dropping by 12%. We see that the global markets actually went up by 4.2%, but that number is kind of deceiving because the markets dropped actually for the first 20 days. The global markets dropped for the very first 20 days, but by day 30, not only has it recovered, but it had surpassed its prior heights. So while the Chinese markets were dropping, the market had recovered. And we see that 60 days after that final drop, we see that the global markets go up by 10%. Similarly, if we look at the swine flu in Mexico, we see similar pattern. Markets drop, and then 60 days later, we have a recovery. Our attention for it only lasted for about a month in 2009 in April. The Ebola in Africa, it had a significant impact. And the markets during that period of time in Africa didn't really recover. It kind of dragged on beyond that 60 days. It kind of came up about 2%, so it didn't recover all the losses. But the global market overall kind of recovered as well. And then, of course, the last one pre-COVID was the Zika in Brazil. And we see that in Brazil, from the most recent top to the bottom as a result of the Zika virus, it goes down 20%. But immediately the following 60 days from reaching that bottom, we see that the market in Brazil recovers by 48%. And we see similar movements in the global markets. We see the markets drop, and then there's a nice recovery during the same window of time. So what we see is that a pattern where the market kind of gets preoccupied with the pandemic until the next story comes around. And the trend is that the market kind of gives way as a result of the news, but it reasonably within 60 days or so recovers the majority of its losses. So it's no surprise when we look at COVID that the market from its most recent peak until its bottom, it bottoms out at negative 33% or so. And then for the following 60 days, and only the 60-day window of time past the bottom, we see that the market recovers about 30% of that. Now, the reason why we don't have other indexes other than the global index is because of the fact that COVID was effectively in 211 countries. So there was a global impact as it relates to the markets. So not one market was impacted as a result of this, but globally we saw the impact of that. Now, why is this time different? This time different is because of the fact that we're seeing an economic impact across the world. When you see economic impact over 211 countries, that's a meaningful impact. The estimates around kind of the world GDP projection for 2020, we're looking at a negative 3%, with the G20 countries with a GDP projection of about negative 6.1%. And this is kind of in line with what Jim told us about the GDP for the US. He said that we're going to be around the negative 5%. And the reason we're going to fare out just a little bit better than the other G20 economies is because of the rapid response through policy and political and monetary policy. All right? Also, from a world trading, merchant trading projections, it's looking at a drop of somewhere between 13 and 31%. That's a significant drop in the movement of merchandise across the world, and that's also going to have a significant damping effect on GDP. More importantly, when we look at the overall stock market, we see that the market is not reacting for the most part the same way that it historically have reacted. So if we take SARS, for instance, as we discussed earlier, we talked about SARS about the fact that the global market dropped within the first 20 days, but by day 30, we had jumped up and not only recovered the loss, but had gains. Now, when we look at COVID and how the market reacted, it took 45 days for the market to reach its bottom, and here we are, over 100 days later, and the market has not fully recovered back to its nearest highs. So it's a much different environment. So the question that poses itself, what do we see is going to happen in the market? What do we think is going to happen in the market? And while we can't give you investment advice because we're not investment advisors, but quite a few of our sponsors are, so you might want to reach out to one of those firms, we could tell you what Jim and I are doing with our own assets and what we're thinking as it relates to our own assets. So on the short term, we're being very, very cautious. We're being cautious because there's a number of factors that are coming into play. We're going to see a lot of movement in the market. And we hear a lot of pundits on TV that are applying the Jim Doty rule, the 40 to 45% rule. And we know that if somebody's saying there's a 40 to 45% chance of something happening, the Doty rule tells us that most likely they don't know what they're talking about. Now, what are we looking at on the short term that is saying that we're going to see a lot of volatility? Well, first and foremost, there's kind of a battle, if you will, between what we've been trained as investors from prior pandemics and what we are concerned about as it relates to the activities in the market. So what do I mean by that? Historically, when we look at other pandemics, whether it's SARS, Ebola, the swine flu, or Zika, what we found is that the market always recovered, and it always recovered rather well. So investors don't want to be on the sidelines waiting for the market to recover, and then they come in late. So they're going into the market with the hopes that they don't miss out on that recovery. On the other hand, the market is not driven by fundamentals right now. The market is event-driven. In other words, depending on the events of the day, the events of the week, the market is either up or down, or it starts off up and then it ends up down, or vice versa. So these two things are competing with each other, causing investors to be uncertain and causing them to be in and out of the market rather rapidly, depending on what's happening, what are the events that are occurring, and that motivation, not wanting to miss out on the upturn in the market. So that's one component. The second component that we're concerned about short term is that we are in a volatility market. Now, we're used to hearing bear market, bull market, bear market, the market is going down, bull market, the market is going up. But most recently, and when I say most recently, that's a relative term here, we have what is known as a volatility market. And volatility market where traders and investors are not investing in the movement of the stock in one way or another. In other words, it's not a selling market or a buying market. Right now, what we have is investors focused on the volatility. In other words, they're investing and trading the volatility in the market. Why is that an important factor? It's an important factor because volatility had historically been an indicator, a leading indicator of whether the market is going to be a bear market or a bull market. Typically, in a bear market where there's a lot of sell-off, we see higher volatility. And when there is low volatility, the investment community look at that as a bull market. So when we see trading and volatility and the value of volatility, or we see volatility as an index going up, what happens is that overall market says, hey, a higher volatility indicates a bear market, we should sell. And vice versa, when the volatility goes down as a result of the trading in it, the investment community looks at it and say, hey, volatility is dropping, we should go in. So it's causing much wider swings than what we historically see. Lastly, as it relates to kind of the trading dynamics in the market, retail investors are back. Retail investors, historically or prior to COVID-19, were preoccupied at work with getting work done. But now, they're sitting at home, getting some of their work done if they're working off-site, and they got one eye trained on their work and the other eye trained on what's happening in the stock market. They become effectively day traders. Now, some of the retail investors are investing in what is known as stay-at-home economy. So they're investing in companies like Zoom, companies like Amazon, companies that benefit from we as a society staying at home and having to work and function within the confines of our home. But majority of the movement that retail investors are kind of causing is the price play. It's playing the price movement on a daily basis or on short-term basis. A great example of that, and we don't have to go back too far, we just have to go back to June 5th to June 10th. If we look at $1 stocks, so stocks that trade at around the $1 range, within June 5th to June 10th, we see that those go up by 80% in dollar shares. 80% jump in their value within a 5-day period. My favorite example of this is Hertz, which is the rental car. The company announced that it's going to be in bankruptcy. New York Stock Exchange is threatening to delist them. And what happens to the stock? We see the stock goes from its all-time low. They announced that they're going to go through bankruptcy. The stock drops to 40 cents a share. And within just short few days, we see the stock jump to almost $6 a share after they announced their bankruptcy. And they still trade at a premium from it had retreated to about $2 a share, but they're still trading at higher levels than that 40 cents a share. What's interesting is that they are actually coming out. Bear in mind, they're in bankruptcy. In other words, the potential for their stock to go to zero is technically very high, yet they're coming out or attempting to come out with a $500 million stock offering. So think about, as a corporation, you're in bankruptcy and you're contemplating or you want to sell $500 million worth of shares, and you expect the market to buy it. Why do they expect the market to buy it? Because the market right now is moving more on a price play than it is on fundamentals. The fact that the company's declaring bankruptcy is irrelevant to the trading on a daily basis. Now, from a broader macroeconomic factors that we're looking at as it relates to the movement in the markets, one of the reasons why we see significant movement of the market is that on one side, we're getting some promising economic data, like the retail data that we got, that May retail was up quite meaningfully. But on the other hand, the other side of the camp is saying, well, that's great and wonderful, but we have some issues on the other side of the equation. Specifically, one, people are spending because they're receiving more money in unemployment than they are had they had their jobs, and statistics would suggest that about 4 out of 5 people that receive unemployment are receiving more money out of that unemployment than they would from their wages. And I'll leave the details of that to Ramon Sphere when he covers that portion of the presentation. But once that money goes away, or if that money goes away, all the extra unemployment benefits go away, consumers are not going to have as much money to spend. Moreover, we could have a situation where the reoccurrence of numbers going up in COVID-19, we might not see a shutdown, and odds are, even if we see the numbers spike again, we're not going to see a shutdown, but definitely individuals are going to take a step back and go out and shop. And lastly, these numbers are starting to spike, as we saw most recently. In Florida, we saw that cases went up about 3% compared to 2% in prior months. And the argument here, well, our testing is better. But when we look at Texas numbers, we've seen 11% increase in hospitalization. That means that the people that are getting hospitalized is jumping quite significantly. And by the way, that 11% jump was in one day, in a 24-hour window. So there is that dynamic. A second macroeconomic factor that we have to take into consideration, and Jim explained it in a lot of detail, is that there's going to be a struggle. There's going to be a struggle between inflation as a result of all the increase in money supply and the Fed's intention to keep interest rates low. Because typically the way we deal with inflation is by increasing interest rates to kind of try to head it off. So in that dynamic, if we end up with significant inflation and the Fed leaves it all on its own, then we're going to see the market goes up because inflation also helps equity assets. But if we start seeing interest rates having to be pumped up to kind of address runaway inflation potentially with all the cash that is being effectively printed, then we might see a dampening effect on the market. And lastly, it's more of a political component. And the political component here is that when we look at the put option contracts on the stock market, effectively what investors are betting on the market going down. And when we look at the December contracts, in other words, they're betting on whether they're betting on the market going down in December, it would suggest that there is a significant concern about a Democratic sweep during the election. And the market looks at that and is concerned. It's not a matter of a political, Republicans versus Democrats, but the impact of having a Democratic sweep, Senate, House, and the White House. And the reason for that is that we're most likely would see a rollback to some of the tax advantages that were offered to corporations. In other words, we're going to see corporate tax rates potentially go up. And then you got to remember that the Tax Reform Act, a lot of the individual tax cuts were temporary cuts that would expire in the next couple of years. And if they expire in the next couple of years and we have a Democratic Senate, Congress, and White House, and a huge deficit as it relates to the stimulus that we're putting in right now, what we end up with is a potential for our tax rates to go back to where they were before the Tax Reform Act. So all of these dynamics will impact the market from now until the end of the year, possibly the beginning of 2021. So we'll see that volatility there because of these factors that we shared with you and some other factors that we would need another hour over this economic forecast length to address, but these are kind of broadly the impact. Well, how about the long run? For the long-term investment, we see that the market always recovers. The market always stabilizes. So if anything, right now, if your investment horizon is long-term, 10, 20 years, 30 years out, you just ride that volatility. There is no need to go in and out of the market because it's completely difficult to kind of time when to go in and when to go out. And it's easier to just ride the cycle because we know that on the long term, the markets are upward trending. All right? So what do you do right now? Well, if you have dry powder, if you have the excess cash, it might be prudent. It's not for everyone. It's not for those that are not comfortable with volatility. It's not for someone who's not comfortable with buying something high and it might drop and then it might return to its regular levels. But if you have dry powder and cash and you are able to look at quality companies that have solid financial footing, great long-term growth opportunity, currently underpriced because of all the volatility and the drama that is happening in the market, it might be a great opportunity to kind of cherry pick and invest in some of these quality companies, but you have to make sure that you do your due diligence. All right? With that, I'm going to turn it back to Jim for the California forecast. Have a wonderful afternoon.
Thank you, Fidel. And I guess as Betty Davis would say, it looks like it's going to be a bumpy ride. Well, it's time for our California forecast update, looking more closely at what's going on in our California economy. I wish to express appreciation to our California segment sponsor, Kaiser Permanente, a great organization in the nation. And just to give you an idea how important it is in Orange County, there are 600,000 members, Kaiser Permanente members in Orange County. That comprises roughly 20% of the Orange County population. Truly incredible. So Kaiser Permanente and all the partners and the thousands and thousands of people involved, thank you for sponsoring this segment, but in addition, thank you for all you are doing to providing quality health care, particularly during this COVID-19 crisis. Well, where are we in California? We are growing about 1.5%. It's kind of like a steady state growth here since 1901, the first quarter of 2019. To put that into perspective, we're not growing as rapidly as either Texas or Florida, probably no great surprise there. And we are on the plus side growing more rapidly than New York and Illinois. So we're kind of in the middle of the pack. It wasn't too long ago, just a few years ago, that we were growing about the same rate as Texas and Florida, and since then we've slowed down. But right now we're about in the middle of the pack, and if you look at the U.S., we're growing about the same rate of job growth as that happening nationally. That is until COVID. Here is the change in payroll employment average for the second quarter. The year-to-year change, 16.7%. If we were to do this quarter to quarter, it would be something like 100%, it'd be a huge drop. It would be 16% 4 times. But nonetheless, this huge drop of 16.7%. Put that in perspective, the drop in the U.S. that I cited earlier was 15.7. So the U.S. was a little, California dropped a little bit more than the U.S. But just like the U.S., we see a V-shaped recovery. We see a drop back of percentage terms, minus 8.6 and then 5.6% by the end of the year. So even though the year-to-year change is negative, it's improving from this minus 16.7%. Here it is in terms of numbers. Those are percentage changes, but in terms of numbers, in the first quarter, California had 17.4 million jobs. In the second quarter, dropped by 3 million to 14.5, and we see this increase to 15.9, 16.7. That's that V-shaped recovery. But even with that recovery, please note, from the beginning of the year to the fourth quarter, we're still down by 800,000 jobs, and that's a loss of 4.5%. Even after this recovery, this rapid recovery, we're still down. And that's because of the deep hole that we're in. This is California. This shows you that compared to the Great Recession, just like the U.S., COVID hit was far greater than anything we experienced during the Great Recession. But the COVID hit's going to be short and intense, whereas the Great Recession dragged on and kept getting worse and worse. There's another very important change that one should take into mind. See, we're talking employment numbers, employment changes, but the real economic effect, especially when you're talking about state product or real GDP, is spending. And the jobs that were lost, this is the average job loss, that 16.5% that I just spoke of. Information services, which is the highest value-added activity, highest paid workers, and basically Silicon Valley, state very much dependent on the Silicon Valley, is the one sector in the state that did not lose jobs in the second quarter. Slowed down, but did not go below zero. So the strength of information services in the state of California is very important for the overall health. These numbers explain why. The average salary in California in 2019 for all industries, about $70,000, whereas about $190,000 in information services, almost 3 times as great. So the fact that California was able to hold its own in these high-paying jobs will overall help that V-shaped recovery translate into more spending and a smaller loss in actual state product. That's beneficial to the state coffers as well. Now, I'm sure all of you, at least in California, have heard Governor Newsom's announcement of a staggering $54 billion budget deficit. Now, with the general fund being at $150 billion, obviously $54 billion is just that, staggering. One can't help but think that it will lead to a required tax increase to balance the budget. But let me take a few minutes to try to deconstruct this budget because it's complicated. Let's look at the $54 billion and see where that comes from. It's not any single year. It's actually comprising 3 fiscal years, but more importantly, it's including these COVID-related costs that will largely be offset by the CARES Act and additional federal government funding to help states and local areas. So this is going to go away. This is history. So this is where we have to focus attention. Not on the $54 billion, but on the $32.2, because the governor is required by law to present to the legislatures and the Assembly, the Senate, a balanced budget. Well, this is certainly not in balance. Now, let me give you a little good news. The governor presented this in April, but the May revision, because of new estimates, showed that this deficit was actually not 32, but 28. So it was an improvement by about $3 billion. In 1 month, that's not too bad, but we still have a tough nut to crack here with $28.5 billion. Let's look at that $25.5 billion in more detail and see how it happened. Expenses in January in the general fund are budgeted at $153.4 billion. It was in January. Revenues, even with that additional $3 billion as a result of the May revision, that comes up to $124.9 billion, and the deficit is our 28.5 that I just talked about. Now, the governor is required, this May revision, to produce a balanced budget. And here's how he and his team propose to do that. On the revenue side, they'll take 7.8 from the rainy day fund, various transfers, prior year surplus, and enhance the revenues by $15.9 billion. On the expenditure side, the governor is proposing a cutback in other expenditures of 5.7 and K through 12 spending 6.9 for a total decline of $12.6 billion. Now, on a budget of around $150 billion in expenditures, this represents about 8.5%. A lot, but not a draconian cut, about 8.5% cut in spending. Largely, many corporations are within that same kind of range in terms of their cutbacks. Now, to see how these enter into the budget, here's where we were before. Here's the $28.5 billion deficit, but expenses are proposed to come down 12.6. Revenues increase 15.9, and that will create your balanced budget of $141 billion. But the story gets better. If we take this revenue estimate of 124.9, that's right here, that's the May revision projection, that's after that $3 billion enhancement. That is based on the assumption of an L-shaped recovery, a big drop and then very little recovery for the rest of the year. It's probably prudent financially budgeting, and conservative budgeting is responsible budgeting. But if you believe what we're saying about a V-shaped recovery, and you plug in our numbers into our model for revenues, and our forecast for general fund revenues have been very, very accurate, we're estimating or forecasting $138.3 billion, which means that if the governor and if the state holds to those revenue enhancements, those expenditure cuts, we'll actually be in surplus at the end of the year by $13.4 billion. Perhaps he'll restore some of the spending cuts with this. I would suggest that maybe those funds can be distributed to cities and counties where the financial problems are more dire than they are in the state. But that's a different story. The point here is that these numbers suggest, in spite of that $54 billion deficit, there's no need, critical need, for any tax increase. Now, I have been talking about COVID and the CARES Act in terms of fiscal and monetary policy in macro terms. I've kind of been looking at the forest. Ramon Sphere, who's the director of our Center for Economic Research, is now going to talk about the trees and how COVID and the CARES Act will be affecting individual industries, but employees as well. Here's Ramon Sphere.
Thank you, Jim. Ladies and gentlemen, good afternoon. In the last several months, millions of Americans have lost their jobs. Others are working part-time instead of full-time. We conducted a study to quantify the amount of income that employees will lose because of COVID-19. We also computed the amount of money that the government will give employees who have lost their jobs. The purpose is to know whether the money from the government will make up for the loss in income to the employees due to COVID-19. We will start talking about the loss in compensation, and then we will talk about the unemployment insurance benefits that the unemployed will receive from the states, and at the end, the federal assistance through the CARES Act. I'm using the word compensation because we'll be talking about wages, salaries, as well as benefits. We know how much income was in the first quarter of 2019. It was a little bit lower than if we did not have COVID-19, because in the last 2 weeks of March, many people became unemployed. So we estimated that loss in income to employees, and we added it to the income that we know for the first quarter to come up with an adjusted income as if we did not have COVID-19. The second step was to forecast employment in the second, third, and fourth quarters. Knowing wages and salaries for 16 different sectors of the economy, and using the forecast of employment, we are able to compute total compensation for the second, third, and fourth quarters. The difference between the adjusted income of the first quarter and the expected income in the second, third, and fourth would be the losses in compensation to the employees. If we add all these differences, we come up with the total losses in compensation to all employees. Here are the results. What you see on the slide is the sectors that lost or expected to lose the most compensation. Manufacturing will lose in 2020 around $40 billion. Retail trade close to $34 billion. Professional and business sector, $50 billion. Education and healthcare, $51 billion. The sector that will lose most is leisure and hospitality at around $80 billion. That sector has the lowest salaries among all sectors. But employment in that sector is so high, and the unemployment rate in that sector came out to be so high that the losses will be the highest of all sectors at around $80 billion. The total losses in compensation to all employees are computed to be around $387 billion. First, we would like to compute how much the employees will receive in state unemployment insurance benefits. We know that amount that was paid in the first quarter. And in that quarter, there were around 6.2 million unemployed. We computed the expected state unemployment insurance benefits for the second, third, and fourth quarters for those who will be employed over and above the 6.2 million that were expected during those quarters. That total is $144 billion. That's an amount over and above what is paid to the average 6.2 million over the whole year. In the CARES Act, there is a provision called the Unemployment Insurance Provision. It provides $600 per week to those employees who lost their jobs and are receiving unemployment insurance benefit from the state. That's $600 a week. The total is around $220 billion for 2020. Mind you, we did not include the money that is paid by the federal government to those who own their own business. Then there is also what is called the recovery rebates for individuals. These are the checks that are paid by the IRS to individuals. Singles have received checks for $1,200, and married couples have received a check for $2,400. The total is expected to be around $300 billion. Already the IRS has sent checks worth over $267 billion by June 3rd. So the total money that is given by the government to employees amounts to $664 billion. If we put all these numbers together, the government assistance is $664 billion. Compensation losses amount to $387 billion. So employees will be receiving, in 2020, $277 billion over and above what they would have made if they did not lose their jobs. I should mention here that the 277 may be overstatement because the checks that were sent by the IRS were also sent to self-employed people. Now, however, Congress is now considering extending the $600 per week unemployment insurance benefit beyond July 31st for maybe 2 or more months. President Trump has a different idea. He would like to give employees who go back to work an amount of money rather than giving it to the unemployed. The reason is the following. The $600 a week turned out to be a disincentive to go back to work. Employees would like to stay unemployed until after July 31st because the money that they are making from the government in unemployment insurance, including the $600 a week from the federal government, is more than what they were making as full-time employees. So they would like to delay going back to work as much as possible. So if any of those programs or any similar program will be enacted, the 277 will actually be an understated amount. Now, I should also add that companies who have furloughed employees also would prefer not to call those employees back, and they would prefer that the government would extend the $600 per week further because they can keep them on furloughs and they would still be getting money from the federal government, and then the companies will be able to call them back when the economy recuperates nicely later on in the year. Thank you very much for attending this presentation, and I also would like to thank you for supporting our students. Here's Jim back to present the Orange County forecast.
Thank you, Ramon. Whew. Those numbers on the CARE Act, when you really begin to analyze it, as Ramon has done, it really brings to bear how enormous the economic impact and how aggressive this time around fiscal policy has been. Well, we're bringing our forecast from the national to the state and now to the local level, Orange County, and I wish to express appreciation to our Orange County Forecast Update segment sponsor, the CEO Leadership Alliance OC. Very innovative organization. I'm really proud that Orange County has this kind of organization, in that one of the few that I know of, maybe it's the only one, where CEOs have gotten together. Real leaders of Orange County, business leaders of Orange County have gotten together to promote Orange County as a place to create business opportunities and, most importantly, job formation. Hopefully job formation of those Chapman University graduates of the future. Express appreciation to Mark Percy, who's leader of that organization, for his support of the Orange County segment. Well, some of you out there globally may be tuning out and thinking, well, I don't have to worry about Orange County. I'm over here in Italy, Spain, or wherever, and listening in. Orange County, I'm going to be talking a little bit more about the residential side, and what's happening in Orange County probably is very similar to what might be happening in your local areas as well. First of all, in terms of comparison, just to give you a frame of reference, Orange County suffered just like California, even a little more so. The hit to Orange County was a little greater in terms of job growth, around 70% decline in that second quarter. In terms of Orange County, it's 15.4% from April 19 to April 20. These figures, this is the first monthly figure where we were able to see pretty much the full impact, the enormity of the COVID-19 impact on the economy. And this mid-April 19 to 20 allowed us to compare Orange County to other counties. As you can see, Orange County was hit a little harder, a lot harder than the Inland Empire, which is more immune on the leisure and hospitality side, but a little bit more than all of these other counties. And the reason for that, not surprisingly, is because there's a higher proportion of leisure and hospitality workers, jobs in that segment of the market. To give you an idea how much of an impact it had, this compares the losses in leisure and hospitality to every other segment of the market. If you were to add all of the other declines for every other job sector in Orange County, it wouldn't even add up to the loss of almost 80,000 jobs in the second quarter in Orange County. Interestingly enough, the only market sector that increased was state government employment. This gives you a frame of reference with the Great Recession. This is Orange County, both in terms of how Orange County's leisure and hospitality sector performed in the Great Recession versus COVID-19. Orange County, during the Great Recession, its leisure and hospitality sector was marginally affected, very little change. COVID was enormous, more than a 50% drop back in terms of employment losses. Very important, and especially when you consider that construction employment this time around was not as much of a hit as it was in the Great Recession. The Great Recession was largely a construction-led recession, not only nationally, but especially so in Orange County, where the construction sector is more important proportionally in terms of the overall economy. Construction employment kept dropping 7 quarters to the point where it was almost a 30% drop back. COVID hit it. COVID had a negative impact, but it's already recovering in terms of our forecast in the third and fourth quarter. We believe that's going to be continuing. So COVID was largely in Orange County a leisure and hospitality-led recession, whereas the Great Recession was a construction job loss-led recession. Very important, because when you look at salaries in those sectors, The overall average salary is around $70,000. Construction, high value added, a little bit higher than the overall average. Leisure and hospitality is less than half of the value added or the annual wage. So take those job losses of 80,000 don't have the same economic impact, because when you translate them into dollars, because of these lower wages, it's a smaller hit, negative hit. Construction is going to be relatively strong in Orange County, unlike the Great Recession, largely because of the increases in housing affordability. Believe it or not, housing affordability has been increasing rapidly, not just recently, but since the end of 2018. 2018, housing affordability was at around 65, which basically tells us that median family income in the county, as high as it was, or was back then, was 65% of that necessary to qualify for the purchase of a median-priced home in the county. It's since increased to 80, sharp increase to 80. So now median family income, it's not enough to qualify for full purchase, but it's 80% of that necessary to qualify for the purchase of a median price home. Why? Well, a number of things. First of all, median family income has been increasing in Orange County. That's helped affordability. Housing prices, whether you know it or not, have been increasing at a very slow rate in Orange County, especially last year and continuing this year. But most importantly, mortgage rates have been down, and that's led to higher housing affordability. That will help lead to housing permits increasing in the third quarter, which again starts in 2 weeks, and then the fourth quarter, where it's basically back to a steady state rate of around 2,500 units. So we see kind of a V-shaped recovery going on the permit side, and largely because of increasing housing affordability. Might ask, this is coming out of our econometric model. Are there any other things out there that might give you confidence or buttress and support this call for a recovery on the housing side? Well, there is, and I'm going to go to the most important variable in our econometric model that explains permits, and that is the average number of days on the market to sell a home. The more days it takes to sell a home, the weaker the market. The fewer the days, the stronger the market, and more pressure on prices and housing activity, both resales and new home construction. Look at what, just comparing from January, this is this year, 2020, from January through April, it took fewer days to sell a home in Orange County than it did back in 2019. And that led to what is called a seller's market, a stronger housing market. COVID-19 hits, the pandemic, and the market weakens very quickly, takes longer to sell a home in Orange County, and it very quickly becomes a buyer's market, a very weak market. And this would translate in our econometric model to lower permit activity, both resales and new home construction. But notice what's happened over the last month. And just recently, we had the most updated figures from the Orange County Housing Report that points to the fact that we are back again in a seller's market. That forecast of a stronger housing market, however, does not translate to a big pickup in housing appreciation. As shown in this graph, in 2019, we had housing appreciation of about 1%, and in 2020, we're forecasting maybe a little higher at 1.4%, but nothing like what we're experiencing in the nation. Housing appreciation in 2019 in the U.S. was 5%, and we're forecasting in 20 in the U.S. 4%. So Orange County home prices are appreciating at a much slower rate than the U.S., but still positive. So those people who were worried about, for good reason, the COVID-19 hit on housing and housing markets and the possibility of a big depreciation, we don't see it. We see it holding its own, not a whole lot of appreciation, but at least it's above zero. By the way, the fact that we've had now 2 years of running where the U.S. Home prices are greater than Orange County, they're beginning to catch up to Orange County. So, maybe in 1,000 years, Orange County may be the affordable place to live in terms of home prices. Well, that brings us now to, I guess, the fourth segment of our forecast, and that is we were brave enough now to talk about forecasting the economy in a COVID-19 environment. I guess we may be even braver to talk about the election and forecasting who will win. Will it be Trump or Biden come November? We have a model. Before I get into that forecasting model and pointing out how accurate it is, this gives you, since 1956, when Dwight Eisenhower defeated Adlai Stevenson by about 16%, difference in plurality vote, these are the results for those 16 elections since then. Just a frame of reference, this was 72 when Richard Nixon defeated McGovern, in 80 when Carter lost to Reagan, and then in 84 when Ronald Reagan defeated Mondale. So big changes here, but this is the historical analysis of what's going on in those 16 elections. Here at Chapman, and to my econometric students out there, thank you this last semester for helping me revise, build, and come up with an even more accurate model. When you put the equation that my econometric students and I put together and plug in not popularity or voter approval rankings, but just economic variables, real GDP, inflation, job growth, and plug those numbers into the equation, it comes up with this yellow line. It's so close you can hardly see it until more recent years. Notice not only is it accurate, it gets the peaks, it gets the extent of the wins on the incumbent party side and the losses as well. Notice how close it captured Nixon's victory here, Reagan's victory here, and again, to look at this in a little more detail, out of the 16 elections, there was only one miscall in terms of calling the popular vote margin for the incumbent party. In 1960, the model predicted a very narrow Nixon popular vote victory. Turned out it was a very narrow JFK victory. But those of you who are around in Illinois, Texas, may remember there were compelling cases of voter fraud that occurred both in Mayor Daley's Illinois, or Chicago and Illinois, and LBJ's Texas. So that one's under protest. That's the only miscall out of 16 elections. In addition, this is also interesting, more recently, the model has not been it's called every election, the popular vote victor accurately, but not as close a call as in prior years. Maybe the economy is not as important to voters. That's a possibility. Maybe it's polarization that's going on that explains it. I don't know, but the model simply has not been as accurate. Nonetheless, calling 15 of 16 elections accurately, and with this protest in 1960, is a very accurate equation. In fact, it's probably one of the more accurate equations I've been estimating in my career as an econometrician. What are we calling for? If you plug in this COVID-19 year and this devastating second quarter, and just for turns out people have a short memory, the year of the election. Turns out that the equation calls for a minus 10% voter loss in the popular vote for the incumbent party being the Republican Party, which means that the model calls for a Biden win by 10%, pretty significant victory. Now, those of you who don't like that, some of you may be elated, but many of you out there may be disheartened by this. You might just discount this and say, this is COVID. Voters are not going to blame Trump for the weak economy this year, the recession this year. They will chalk it up to a COVID, an act of God, if you will, not because of the president. But when you think about it, previous recessions, for example, when George Bush Sr., or H.W. Bush lost in the first election to Clinton, there was a recession that year. I don't think Bush was responsible. The voters blamed him for it, whether he was responsible or not. And if you look at the polls in January, a random sample, this is a Gallup poll, turns out that in January, that is surveying Democrats, Republicans, and the result was that 64% approved or had confidence in the president's handling of the economy. The most recent poll, those same independents, Republicans, and Democrats, it's dropped to 47%. So it appears voters are blaming Trump, at least to some extent. Maybe you'll turn that around, but this is what the equation is saying. Also hard for me to believe that when the margin is this great, even if we're wrong and even if COVID isn't totally blamed on Trump, this is going to be a pretty big deficit to overcome. Again, many of you may find this disturbing, but I have to tell you something that happened to me recently that I found very disturbing, and that is the best response on the student evaluation. This is the winner. The last one was a runner-up. I've been teaching for many years, and over those years I've received some very critical, some very nasty evaluations. But in all those years, this response I have found to be the most disturbing, maybe disheartening, and it is, Dr. Doty is a sweet old man. You know, I think all of us tend to think of ourselves, especially senior citizens, as being younger than they really are. But this is a real dose of reality. Well, that brings us to takeaways. Let's summarize what we've talked about here in this forecast. Most importantly, we're forecasting a V-shaped. We're optimistic in terms of the recovery, short but deep. It's a big hole. It's going to take us a while to dig out of. There will be some jobs that never come back, and that's kind of the survival of the fittest in a market economy during recessions. The retail sector, for example, much of it has been just struggling along, competing with e-commerce. But now a recession will mean that many of those firms will go away forever, allowing the resources in that industry to branch out into supporting e-commerce or other areas of the economy. This V-shaped recovery is largely as a result of a very stimulative fiscal monetary policy. We see ourselves recovering 75% in the U.S. of lost jobs by year end. It's going to take us longer to get all the way back to 100%. If you believe in old monetarism, Friedmanite kind of monetarism, there's a good chance of renewed inflation hitting 2021, and you should begin preparing that. As Fidel said, something that we have to look at. Inflation has a major impact, not only in terms of Fed policy, but of course on interest rates and mortgage rates. If you believe this, and you're not a devotee of the new monetarism, and you are actually concerned about the possibility of an uptick in inflation, you may want to lock into low mortgage rates that we have today of around 3% for 30-year traditional mortgages. And as Fidel has told us, the stock market's going to be a bumpy ride, but maybe a good inflation hedge if you believe in this relationship between M2 and prices. Well, those are the takeaways for the U.S. Moving on to the state and local areas, California will benefit from the continued strength in information services, so we'll help buoy the losses going on, especially in leisure and hospitality. There's no need for a state tax increase, at least based on our analysis. This is not saying there won't be one. It's saying there's no need for one, at least in terms of the recovery that we're forecasting. Orange County lost more jobs in other areas of the state, but again, those are in sectors with low wages, so that will moderate the degree of loss. in Orange County housing market, it's already in recovery mode, and we believe that recovery will gain in intensity as the year progresses. And finally, looks like Joe Biden wins big, at least based on this model that my econometric students put together. So if I'm wrong, or if this is wrong, don't blame me, blame my students. That brings us to the conclusion, but not the end of the forecast, because this is the first time we've ever done a virtual forecast, and this is the first time we're ever going to have an online auction. This is a photograph of me in my wood shop. In my spare time, I'm a bowl turner. You put a piece of wood, a chunk of wood on a lathe, and you hollow it out, and you make bowls, and I'm a bowl turner. I shared this with my econometric students, some of my bowls, and one of the more creative students raised his hands, and he said, you know, have you ever done a bowl in the shape of a normal curve? Now, the reason he asked that, the normal curve is the underlying foundation of statistical analysis, econometric analysis. So I could see why he was asking about doing a bowl in the shape of a normal curve. Well, I took that as a challenge, and pleased to say that this was my creation. I believe this is the only bowl in the world shaped in a normal curve, and the reason I'm sharing all this with you is that I am putting this bowl, the only normal curve bowl in the world, up for auction. It's made of AAA graded tiger maple, beautiful, I don't know if you could see it on your screen, but beautiful grains, even a ferrous metal band here. And it's all my pieces are signed and numbered, and this is number 69, and this is going up for auction. This shows you the normal curve, and there it is. And submit your highest bid in the dialogue Q&A, and we'll announce who is the recipient at the conclusion after the Q&A. Just to give you a frame of reference how much these bowls are worth. This is one of a kind, maybe the only one in the world. But I have to share with you an auction where I donated a bowl to the Shea Center auction. Shea Center is a wonderful nonprofit, helps kids who are physically challenged with equine therapy, do a great job. And so I was auctioning off one of my bowls, and a good friend of mine, Jimmy Peterson, one of the corporate leaders of Orange County, philanthropist, just a great guy, very well-respected community leader. He bid $25,000. He got my bowl, $25,000. That's the highest bid on a Doty bowl. So, Jimmy, if you're out there listening in, this is your chance to get a second bowl, okay? But I don't know if we're going to get Jimmy to do that again. So to make this offer even more exciting, if you act now and you're the winner of this auction, we are going to throw in a set of Ginsu knives. So it's all in your hands, and to get the auction going, I am personally going to start the bidding at $1,000. I'm doing so because, first of all, I have to preserve my reputation as a wood turner, and I can't have a bowl go out for less than $1,000. But secondly, you know, I wouldn't mind getting a set of these Ginsu knives myself. So the auction is now commencing. Good luck, and now we'll start in on the Q&A and have Fidel, Lawandi, and Ramon Sphere join me.
Thank you very much to all of our presenters, and thank you to all our viewers. And most especially, thank you to our sponsors for joining us today. As a reminder, please stay tuned for a question and answer session which will start shortly. Again, to submit a question, please do so using the dialog box. We'll see you shortly.
Well, thank you for tuning in, and I hope you agree with that student who on the student evaluation said they like Doty better online than in person. Hope you also like Ramon and Fidel on better online than in person. I understand there was a glitch at the beginning of the presentation. Some of you came in late. The reason for that is we had 4,000 registrants, but 5,000 tried to get on. those are big numbers, especially considering that our live update forecasts usually bring in 1,000 people. Anyway, the system was overloaded, it crashed, and you all have a chance to watch it all over again at the conclusion of the Q&A, and I'll talk more about that later. It was either that caused the problem, or Fidel, when you spilled your Coca-Cola on the terminal back there, that might have done it. Those of you who are interested in the Doty Bowl, if I might have another opportunity to hawk that all over again, you make sure you give us your name and contact number, including the amount that you're bidding, so that we can get back to you. And I'm even throwing in addition to the Ginsu knives, I'm even going to meet you for lunch. That may lower the bid, of course, but I like to know who my Doty Bowl holders are, know them personally, so we can have a lunch to do that. So that's part of the whole overall package. So again, thank you for joining us for the Q&A and the miracle of technology. I'm getting the questions as you're asking them, and I already have quite a few excellent ones. The number one came in. The housing market is strong at the moment, and demand is increasing as we move into the summer months. Do you see the real estate market continuing to add fuel to the local economy? Well, the local economy, Orange County, permits, which during the COVID crash dropped to about 1,600 permits for single-family housing and multiple housing units as well. We are forecasting in the third and fourth quarter to increase to 2,600 units, so 1,000 additional permits. Those permits are important because that permit is an indication that a home is going to be built, which means that more construction workers will be hired. It's a long-term effect. First of all the construction spending, but then when the family moves in and buys household appliances, et cetera, that will increase spending, not only through the end of the year, but through most of 2021 as well. So construction will be locally and even nationally an engine of economic growth and will help be part of that, propel that V-shaped recovery. Second question is, and I'll direct this to Fidel here. What are your opinions on current stock market valuations? Do you think the current stock market reflects the Chapman Economic Forecast, the gist of the Chapman Forecast?
Well, it reflects the Chapman Forecast in the fact that our numbers seem to indicate that there is a recovery. So if there is the consensus out there that agrees with us that we're going to see a V-shaped recovery, it would make sense that we see that the valuations or the market kind of returns to close to its highest numbers pre-COVID, because of the fact the market is betting on earnings coming back, the economic activity coming back to pre-COVID-19. The challenge that we're seeing today in the market is the fact that it's an event-driven market. It's not based on fundamentals. You're seeing the movements based on what's coming out in the news. We're seeing that the movements is investors betting on prices. It's what I teach in my classes, the castle in the air theory. I will buy it at a higher price as long as I could find somebody that is willing to pay for it more, irrespective of what the fundamentals are. So there's a price play that we discussed in the economic forecast that is impacting the valuations in the market as well. So it's going to be a bumpy road because the market is reacting to news, it's reacting to price play, it's reacting to the volatility in the market.
Yeah. And if none of that turns out to be the case, sue Fidel and not me.
This is my opinion for my own investments. It's not advice.
Okay. Thank you, Fidel. Okay, what happens to the economy if Biden is elected? And that was our presidential forecast. First of all, what happens to the economy? Well, generally, the first year of a Democratic president generally has a very positive impact on the stock market. There's an expectation that fiscal policy will be liberally used, even more liberally used than I guess what we've had. I would imagine a lot of social overhead spending as well as infrastructure spending. But a lot depends also on what happens to the Senate. That's going to be a major, major factor that will have. So if not only of a Biden presidency, but the Senate turns Democratic, then you probably will see a lot of fiscal stimulus which will, at least in the short run, have a beneficial impact on the economy. Longer run things like regulation and higher taxes, that might come later, but too early to say. Of course, if Biden isn't elected and Trump wins, means I'll probably have to throw out our presidential indicator forecast. I'll have to eat crow in December when we have our forecast. I'll even invite President Trump to the Musco stage, and he can even call me Little Jimbo or whatever he wants. Anyway, let's go on to the next question here. Oh, we currently have a bid. So if we have a bid on the, I'm safe. I don't have to spend the $1,000. So Cheryl Bourgeois, don't come to me for the $1,000 because we have a higher bid, $10,000 from Dave Wilson. So if you want the Doty Bowl, if you want the Ginzu knives, and the lunch with me, then you have to do over 10K. So thank you, Dave. Great guy. Toyota of Orange. I think you deserve that plug. Okay, will we see hyperinflation due to the money that the Fed pumped into the economy? If so, when? Well, that relates to the Friedman admonition that inflation is always and everywhere a monetary phenomenon. Our forecast, given the lead lag between M2 growth and prices, calls for, as pointed out in the forecast, mid-2021. But I would not say it's going to be hyperinflation like Germany experienced during the Weimar Republic years of 1920 or so, but higher inflation. But as soon as you get that uptick, I believe Jerry Powell, the Federal Reserve, will be very aggressive on constraining monetary growth, contractionary policy rather than the aggressive monetary policy. The problem there is that could lead to a recession down the road. So we're not going to experience hyperinflation, but an uptick of inflation to 3%, 4% could spook the Fed and lead to the kind of contractionary policy generally associated with downturns and recessions. Okay, the next question. How can you compare the COVID-19 recession with the Great Depression when the entire system surrounding each recession are completely different? Don't you think that there are better recessions to compare potentially and internationally? Good question, good critique on the forecast. I guess I'm the one who was comparing it to the Great Recession, so I'll take that question and defend myself by saying, first of all, the Great Recession was relatively recent. We have to really go back to 2000 before we get to the next recession, completely different from what we're experiencing now. There's nothing been like the COVID recession. We have to go back to 1919 when we had the influenza, the so-called Spanish flu, to get anything comparable. And that was a completely different era. So I think my decision in using the Great Recession as a relative recession to compare ourselves to was basically because it was relatively recent, but also because there's been a lot of commentary in the media about that this COVID is going to be even worse than the Great Recession. And the gist I gave it was that it's certainly going to be deeper, but not as prolonged as the Great Recession was. Okay, in reference to the drop in housing units, it looked like the past drop of 1.5 million units you referenced was over a period of several years. Is it really fair to say that because we're only experiencing a 50K drop this year, that we won't ultimately see the same type of decline as in the past? No, I think I'm very confident in saying that this is nothing like the construction decline that occurred, as the person who asked this question is correct. That happened over a 3 to 4 year period, but each year it was far greater than the 50,000 unit reduction that we're seeing seen in the U.S. So not only was it deeper than that every year, but it extended over a much longer period of time. So there's no comparison on the construction side between this COVID recession and what we experienced in the Great Recession. Some industries seem to thrive during the pandemic. They're pandemic-proof, like Zoom and Amazon. What are the industries that will really boom in the post-pandemic economy? Good question. I guess, Fidel, where should we invest our money in terms of equities? What companies will do well?
Well, I can't give any investment advice, but we have a lot of great sponsors that are financial institutions that could actually provide that professional investment advice. But in looking at the current investment market, I would suggest that in the stay-at-home economy, so all the businesses or industries that actually support the activities that we're doing staying at home. As you mentioned, like Zoom, Amazon, Postmates, and the Uber Eats, and those companies that are benefiting significantly from the fact that we're kind of stuck at home. But what's interesting is that the way we conduct our work, the way that we decide whether we're going to go out to eat or order in, a lot of that change is going to continue to stay beyond just the COVID-19 kind of stay-at-home orders and whatnot. And we'll see that more people are going to work from home instead of commuting. And a lot of the industries that support that type of economic activities are going to benefit moving forward beyond the COVID-19.
Okay, thanks. Here's a question that's, I think, the big elephant in the room. I'm glad this question was asked because I think it needs more perspective, and that is, in light of the uptick in COVID-19 cases in Florida, Texas, Arizona, and I'll even add Orange County because there's been an uptick there, will that lead to your revision in your forecast? Maybe Ramon, what do you think? What do you think of this, this recent uptick?
There will be some communities and some areas in various states where there is an uptick, where they have to take a step back and ask people not to really go out as much as they did in the last few weeks, which has led to really to a larger number of people being, getting the virus, and the positivity percentage became higher and higher. So that means taking a step backward, and that's going to hurt the local economy where that is going to take place.
Don't you also think that some of the uptick is because there's more testing?
It's true that the larger number of people who are tested, the more people you find that they have the virus. But the positivity is the percent of people who are being tested have more the virus. More
so even with
before.
more tests,
Exactly.
A greater proportion of people are testing positive.
This is the bad part.
Yeah.
Okay.
But the death rate is not increased significantly. But there's a lag between the diagnosis and
Correct.
potential for death.
Correct.
Yeah.
In some states, the hospitalization numbers are really going up. And those on respirators numbers also are going up, and in some areas they are running out of beds for those who are seriously ill. So some states are going to be hurt more than others in that case, yes.
So I think that social distancing will continue. By the way, on that point, social distancing, I hope you all see that we're good citizens here and we're 6 feet. In fact, we're so far apart I can hardly hear you, Ramon, with my being hard of hearing. But anyway, social distancing, wearing masks will continue. Yeah. But do you see this summer, this uptick leading to renewed shutdown, stay-at-home orders?
No, I don't. The number seems to be going up in some areas, but going down in some other states. So it's almost half and half. But by the end of summer, things, I think from what we read about the medical community, saying that things are going to improve. Now, whether we will end up with a second wave by the end of autumn, like in November or December, that's a completely different question. It's very difficult to answer at this point.
On this point, going back to the influenza of 1919, incorrectly called the Spanish flu, it wasn't really a Spanish flu, but it was a very deadly flu and affected far more people than COVID-19. Almost 800,000 people contracted, and it was more lethal as well. When that happened, it happened in the spring of 1918, but it came back, a second wave, in the fall of 1918. It was far worse. It was more lethal, and more people contracted it, and it continued into 1919 as well. That's a concern, and we're not. No one really knows what's going to happen. On the plus side, we'll have more ability to diagnose cases. There's more planning. We certainly learned from the experience in the spring, but it could be bad enough that it might lead to renewed shutdown orders and stay-at-home orders over and above social distancing. And if that happens, all bets are kind of off.
Correct. Yeah. You know, in 1918, the United States was in the middle of the First World War. And the administration was busy with that war, funding it, and they did not really take great care of what's going on, on the ground here, and taking care of. They didn't have the vaccine, they didn't have the medicine that we now have. So the situation is completely different.
And it could also be, if there is this second wave, what we've learned, and we'll learn more as we look at the data and analyze the data, could very well be that it will be more selective, maybe more like a Sweden type strategy, and that is focusing resources on the most vulnerable, those who have weakened immune systems, those people who are senior citizens who have weakened systems or have a history of health-related problems. So it'd be focused strategies rather than this macro kind of shutdown that we experience. But we don't know. We're speculating. We'll just have to wait and see. But that certainly is a risk to the forecast. So if our forecast goes wrong, that could be our excuse come next December. Here's an interesting question. Taking a look at your own industry, what are the biggest dangers to higher education as we move through the year one of post-COVID-19? Speaking of higher education. And we all were required mid-semester to develop hybrid type of systems and online education. What kind of impact will that mean in the future? It gives me a good opportunity to plug something. A person who's shown great leadership here at Chapman University, Daniele Strupa, through this, has announced some very innovative, I think, path-breaking plans that are being emulated by other universities around the country, devised by Daniele Strupa, Harold Hewitt, and others in our academic administration, Glenn Pfeiffer. And I will have the privilege of interviewing Daniele Strupa at a Chapman Connect show. In fact, in the coming weeks, every Tuesday, 3 o'clock, there will be a half-an-hour Chapman Connect show. And next week, in fact, I have the privilege of interviewing Mike Masalam, one of the most distinguished CEOs in the nation and the world, heads up Edwards Life Sciences, one of the largest companies in Orange County. So I'll let Daniele take that question when I interview him sometime later in the summer. Fidel, is the disconnect between the stock market and the Main Street economy a fluke or the start of a long-term trend? Is the stock market moving counter to what's going on in the economy?
Right now it is, and it goes back to my earlier answer. It's just that right now the market is betting on volatility. As I mentioned in the economic forecast, we used to have the bear market and the bull market, and that's what we're familiar with. But in most recent history in the stock market, we're seeing more of the volatility market. Investors that are trading on the volatility, trading on the movement in the price, trading on the volume than basic fundamentals or economic factors. So yes, as algorithms are trading, day traders, retail investors, volatility investors, all of that will create kind of more noise in the way the market performs compared to the economy, for sure.
Okay. This will be our last question. It relates to the CARES Act. So I'm going to ask you, Ramon, to field it. And excellent question. What are the prospects for CARES Act 2? We all know CARES Act 1, about $3 trillion, but the House of Representatives has already approved another $3 trillion package. So it looks like we're going to get something. But but in light of what you just presented, that all those workers who were either furloughed or laid off, on average, actually are receiving more in unemployment funding compensation than they were making on the job. What do you see in the future in terms of fiscal policy, a la the CARES Act?
We should be careful and mention that although all the employees together will be receiving more assistance from the states and the federal government than the income that they have lost due to the coronavirus itself. It does not mean that every single employee is really getting more than what they would have made. This is, as Jim said, this is on average. Okay, so some will be getting a lot more and some are not getting enough to cover what they have lost. It looks like Congress as well as the President are intent on having more stimulus to the economy in the coming, maybe by July, they may make their final decision. It's quite likely that they will extend the $600 per week that the federal government is paying for any employee who is receiving unemployment insurance benefits from the state. How long they will extend it, it's difficult to know. I believe they are waiting for some data to come out on employment and other statistics before they make up their mind. Because there are some people in the Senate, Republicans mostly, who would like to wait a little until some additional data is available. They don't want to spend additional sums of money and add to the deficit if that is not going to be needed. But chances are there will be some assistance to the employees. There may also be some additional checks that will be sent to people who have paid taxes like they did before, and an additional check of $1,200, that's also a possibility. And there may be some additional loans that are given to small businesses who were not able to get assistance from the previous CARES Act.
But in all likelihood, there is going to be an infusion of more, another fiscal thrust, if you will.
Correct.
It's just a matter of how much it will be.
Yes. Yeah. The size of it is going to depend on what's happening to employment in particular in the month of June.
Yeah. And over and above that, the Federal Reserve Board, Jerome Powell has announced that they're not only going to be buying U.S. bonds, but commercial paper and even corporate bonds as well. Yes. All ranked. They don't have to be AAA. I mean, they'll be buying all kinds of bonds. So I think there'll be continued monetary stimulus as well. Well, thank you, Ramon. Thank you, Fidel.
Thank you, Jim.
And thank you all for tuning in. I received word that Dave Wilson, you got that Doty Bowl for 10K, and if you want to increase your bid from 10 to 15,000, you don't even have to have lunch with me. You can get out of lunch with me. Put in that increment. I guess, Jimmy Peterson, you're not out there, but I'll have another bowl for you in the future. And Dave, I just can't wait to give you those Ginzu knives and see what you're going to do with them. Now, if those of you who would like to see this show again, right now, it will air. All you have to do is log in, put in your name, and your password, and you could. So if you've run out of streaming on Netflix, Amazon, Hulu, and all the others, and you've watched all those streaming shows, and you have nothing else to watch, and you have nothing else to do, tune in. And this is even better. Relates to me too. For the hearing impaired out there, on Friday we will have closed caption. This will be in closed caption format again. Just log in whenever you want. Just put in your ID and your password, and you can watch it all over again. There's something else I think they have to do. I've forgotten what else?
Refresh the browser.
Very good. Thank you, Fidel,
You're
who is our, I'm a Luddite here. He's our techie guy. So refresh your
browser.
Your browser. Hope you all understand what that is because I don't. Thank you again for tuning in. And kidding aside, I really appreciate your interest in the work that we do at the Center for Economic, the A. Gary Anderson Center for Economic Research, and the work our students do in the various classes. It really makes a big difference to us. So thanks, and hope to see you, if not December in person, maybe we could do this all over again. Take care, everyone.
Thank you.
Thank you.